Equity mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we help you learn to invest in 45 minutes or less. We break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name's Bryce, and as always, I'm joined by my equity buddy, Ren. How's it going, bro?
Wow, a little bit of a flourish there.
Yeah. Put you on the spot.
Yeah, well, I am good. I'm excited for this episode because, I always say that, I know, but this will be good. I think we have had a lot of questions around what to buy. That is really starting to become the salient question as people get used to spending 24 hours a day in their homes, and people's job situations are hopefully starting to get figured out. Either the government is supporting or they're able to work from home. A lot of people are seeing a lot of bargains. Qantas is a very heavily discussed name in our group, as is Carnival Cruises and Flight Centre. And there's a lot of questions about, is this a company I should be buying? So we're not going to tell you what to buy because general advice only, nothing specific. We don't know your personal circumstances and we are not telling you what to do. But we're going to talk about two really important factors that we think are going to be the focus of a lot of our analysis, and then we'll rip through some of our watch list at the end.
Yes. So we're going to be talking about all things to do with the balance sheet, why it's important to look for a strong balance sheet, and also around earnings. And then what everyone has been waiting for is a watch list of what is quickly growing in quantity. So, Ren, the first question before we do get into the stock-specific stuff, the really juicy stuff, is around, I guess, firstly getting cash in order before we talk about what we're going to do with that and what we look for. And we have spoken about emergency funds to begin, but do you want to address that?
I mean, I think everyone sort of knows where we're going with this. It's only invest what you can afford to lose, and hopefully that message is loud and clear now after the last month and a half we've had. But now more than ever, it's important that you have an emergency fund and you've got the cash to support yourself if things go wrong, because don't expect that you can sell these stocks in 2 months if you need to cover your expenses, because for all we know, some of these stocks might be down another 50%. And yeah, it's just get your finances in order. And in particular, if you've got debt that you need to pay off, like I know the government are now stepping in and they're freezing some things like mortgage repayments and stuff like that.
That's fine.
Yeah, but if you've got money freed up because of that, make sure you're on top of other debts. Like don't say I don't have to pay my mortgage, so I'm going to throw it in the market unless you've sorted your credit card and stuff like that out. Just
pay off your Afterpay, clear your credit card.
Yeah, don't do Afterpay in the first place. Don't have a credit card in the first place.
Do Afterpay because I'm a shareholder.
But yeah, just get your finances sorted before you do anything else, because the worst thing that could happen is your eyes get bigger than your wallet and you buy a whole bunch of companies and then you screw yourself in the short term.
Then you lose your house, yeah.
Yes.
So we've sorted our finances, we have no debt, and we've got a bit of cash to throw in. Are we buying stocks? Are we buying indexes? What's the plan?
It's a good question. What are you doing?
As I have said, at this stage, I'm doubling down on my index exposures.
Yeah, you're the only bloody finance host that doesn't pick stocks.
But very much looking forward to... No, don't get me wrong. I'm definitely going to be buying individual stocks, but taking this opportunity to really build fundamentals. I know you're keen on the stock picking, so let's get stuck into that side of things.
This episode's going to be on how you think about picking stocks, but there is absolutely nothing wrong with that approach that you're taking. I've bought a little bit so far, and a lot of it at this point have been indexes. And so if you don't want the stress of picking stocks, you could literally just turn this episode off. We hope you don't, but you could, and just buy indexes and live a long and comfortable life and just get some hopefully pretty good returns coming out of this dip. So you don't have to pick the perfect stock. You just don't. There's enough stress in the world at the moment. In saying all that, if you do, this episode hopefully will help you with your thinking and help you pick the right stocks.
Yes. So before we talk about stocks, let's think about sectors, Ren. There are a lot of sectors that have been smashed.
Yeah, well, I think this is the first step.
Yes.
So everything we talk about here is going to be in the framework of long-term investing. It's going to be in the framework of something that you want to hold for years, if not decades. So there'll be a bunch of people that try and trade these swings, and because volatility is back in a big way, but that's not what we're going to talk about here. So the first thing that you need to think about is this company going to survive in the short term? And then the second part is it going to thrive in the long term? And so when we start thinking about, is this company going to survive in the short term, the first thing that we probably should think about is the sectors and how they're going to be affected. And so that's what you were mentioning there.
Yes. So there are obviously some sectors that have been absolutely smashed at the moment, and from our point of view are a bit of a red flag, potentially stay away right now. You know, you've got your airlines, you've got cruise ships, and then shipyards. Travel has been absolutely pumped. Private equity, you want to give a bit of an explanation around that one?
Yeah, so private equity is a debt-heavy industry, and a lot of what private equity have been buying are, they've been leveraged buyouts of retailers and stuff like that, or buying distressed assets in the hope of being able to turn them around. There will be some private equity players that come out of this really well because potentially they've just raised a round, they have a lot of cash, and they can deploy it at a really opportune time in a couple of months. But there will be a lot of private equity players that are saddled with a lot of assets that they can't turn around or aren't producing, that have high debt loads, and things could collapse in on themselves very quickly. So I would just be very wary of private equity. And in the same way that everything else you just mentioned, it's not a don't buy, it's just a be wary. And, people, there's a lot of chat about Qantas and Flight Centre, and people will probably make a lot of money on those stocks, especially Qantas, because a lot of the chat is that the government aren't going to let the airlines fall. You never know, though. The government policy can change, or the covenants that come onto a bailout could be very bad for existing shareholders. So you do have to be careful with that. But some of those industries, could bounce back in a big way. For mine, there's just enough out there that doesn't have these question marks. There's so much good, strong companies out there with amazing businesses that are going to grow, and I don't want the stress of wondering what ScoMo is going to do with Qantas. I don't need that in my life.
Yeah. Well, then the questions are, what are the key elements that we look for? And there are probably two which we'll address, and that's a strong balance sheet and earnings, stable earnings. And to your point, Ren, there are a lot of companies that definitely fit into this at the moment and have great growth potential. So the question is, why is a strong balance sheet important now, and why is it one of the first things that you look for?
Yes. Let's even take a step back. What is a balance sheet?
It's a sheet that you can put onto a... No. That's really silly. So a balance sheet shows the company's asset position and cash position.
Yeah.
So it gives you a good understanding of where they sit in terms of how much cash they have versus how much debt they have.
Nice one. Yeah. And every company has to report on it. If you crack open an annual report, you'll see a profit and loss statement, which shows the sales they're doing, the revenue, the profit. There'll be a cash flow statement, which is a deviation of the profit and loss statement in that it shows the actual cash leaving and entering the business. And then the third one you'll see is a balance sheet. And you'll see things like short-term debt, long-term debt, cash on hand, receivables, stuff like that. That page in the annual report, called the balance sheet, is just to give you an idea of the capital structure of the business, how much debt the company has, how much cash they have. You'll see things like shareholder equity, which is like how much value the shareholders own in the business. So yeah, there's a bunch of stuff there. Why it's important is companies with high debt and without the cash to cover that debt not likely to go bankrupt at the best of times because they can pay off their debt with profit coming in, but in times like this, a higher risk.
Yeah. And the risk comes, just to make that very simple, if their revenue is absolutely smashed. And if you take, for example, and I'm not saying their balance sheet is bad, I haven't had a look, but let's say Webjet, for example, it is very clear that their revenue is going to be absolutely hammered. The big risk that they have, if they have a lot of debt, is that they need to service that debt. If they don't have revenue coming in to service it, then they're going to have to start defaulting on loans or finding other ways to service those loans by raising more capital or whatever it may be. So the important thing here is understanding the relationship between their cash flow and their debt.
Yeah. So if you're a company that has a lot of debt and you can't pay it, or first of all, you try and pay it. And to your point there, if you don't have cash coming in the door, you might not be able to pay it. The second thing that you might try and do if you don't have enough cash coming in the door is try and refinance the loan or recapitalize the loan to get a better interest rate or to push the payment date further down the line to give you more time to turn your business around, stuff like that. Unfortunately, credit markets are just in turmoil at the moment. No one knows what's going on. No one's going to want to lend to businesses in trouble. So if you don't have cash coming in the door and you can't refinance your loans, that is why your debt becomes a big issue. So the first part of having a strong balance sheet is having low debt, and in particular low debt relative to the amount of assets that you have on the book. And that's the second thing that we'll get into now. Cash is king. That's really the headline here. Cash or cash equivalents, I guess. Things that can be turned into cash very quickly are so important. And if you just think of it from a practical perspective, one, you can pay your debt off. Two, you can, keep paying the fixed costs that you have, even if you've got no revenue coming in. So we both work in retailers, and fortunately the supermarket sector is doing okay, but let's say we sold shoes and no one's coming to a shopping centre and buying shoes anymore. You still have rents that you have to pay. If you're trying to keep employees on, you still have payroll that you have to make. And if you can't fund that out of revenue, you have to fund that out of somewhere. And so having cash on your balance sheet gives you a buffer, essentially. It gives you time. It allows you to keep paying the bank, keep paying your payroll, keep paying your lease obligations before you have to really start making those difficult decisions or start shuttering stores or start laying people off or start defaulting on your debt.
But Ren, I might look at a balance sheet and see that my company is very asset rich. We've got a lot of inventory. We've got a lot of other sort of assets that are sitting on the books that have a lot of value. I don't have a lot of cash. Is that still good?
Well, it depends. How long is a piece of string? I guess.
My point is around the liquidity side of things.
Yeah. So it depends, essentially. But in a lot of cases, inventory is not as good as cash or cash equivalents. And those two lines are split out on the balance sheet. So you can see how much is in cash and how much is in inventory. And it makes sense. Like if we extend our shoe seller example, if we have no cash on our books, but we have $500 million worth of shoes on our books, that's great. It looks like we got a heap of assets. But if no one's buying shoes, you can't turn that into cash. You can't pay the bank with shoes.
Try paying your loan with a bunch of shoes. Yeah, that's not going to work.
So that's why the best line to have a lot on is the cash or cash equivalents line, because everyone takes cash. Not too many people take shoes. But to my point about why it depends, there are some assets and some inventories that will be easier to liquidate, easier to turn into cash. If we weren't a shoe seller, but we were a toilet paper seller, that inventory is as good as cash and you can probably add a zero to it.
Yeah.
So it just depends, really. But it's a really good question. To take that even a step further, and if we move away from inventory, so like the stock that you hold, and we go to things like property, plant, and equipment, which are essentially your buildings, your land, the machines you use in your factories, stuff like that. If we're a vertically integrated shoe seller and we make our own shoes in our own factory in land that we own, we would recognize all those assets on our books, on our balance sheet, as property, plant, and equipment. In some cases, they may be able to be sold depending on, what the demand is for shoe factories at this time, but it's unlikely that people are going to want to get in the shoe game when no one's buying shoes. So they're probably going to be harder to liquidate. There are probably some things you can do, like you could probably borrow against them. You could probably secure a loan against them to get some cash to keep things going. Potentially you could convert a factory into, what Elon Musk is trying to do and make respirators. So potentially you could use that asset in another way to generate some cash. But again, it's not as liquid as cash. It's good to have. But if we're talking about a short-term crunch on these businesses, it's not going to be as easy to pay the bills with.
So then cash is good, and we know, of course, debt is not something that should be looked upon as a bad thing. Businesses often need debt to finance expansion and growth opportunities or whatever it may be. The question, Ren, I guess, is, are we talking, when I'm looking at these, is the relationship between cash and debt, is it a numbers game, or should I be thinking about it from the point of view of ratios?
It's a good question. It feels like you know the answer in the way that you asked it. Yeah, so big numbers are big numbers, and $500 million in cash is a lot of cash, and $30 billion in assets is a lot of assets. But those numbers are meaningless in and of themselves because they don't tell a complete picture. If a company has $500 million worth of cash, but their short-term debt obligations, the money that they have to pay to a bank within a year, is $1 billion, well, then that $500 million in cash is useless, meaningless.
Yeah.
Unless they're making heaps of profit, then, you're good. So ratios become really important here because they tell a complete story of the business, essentially. They tell you what you need to know about the relationship between the different metrics.
Yeah.
Because we're talking... So there are some that people probably have heard a lot about. Debt to equity ratio and debt ratio are really common ones. One that I think we should touch on here and explain is the current ratio. And the reason for that is because what we're talking about here is a short-term liquidity crisis. We're talking about everyone being locked down in their houses for, let's say, 6 months. Let's hope at less than 6 months, but let's say it's 6 months, and the business having no cash come in the door for 6 months and having a whole bunch of costs that they have to keep paying. That liquidity crunch, that inability to get any cash through the door in the real short term, it means that some of their bigger assets that we were talking about before, their inventory, their property, their equipment, they can't liquidate in a short enough time. So what really matters is cash, as we sort of have mentioned a couple of times. What the current ratio is, sometimes you hear it called the liquidity ratio. It measures the business's current liquidity and its current ability to pay its short-term debt obligations. And so it takes its current assets, which is really its cash and its cash equivalents, and it divides it by its current liabilities. And current liabilities are the liabilities that are due within 1 year. And so if you have a current ratio of 1, that means that the current assets that you have, basically, for ease, let's just simplify this, it basically means the cash that you have can cover the debt that's due within 1 year. If your current ratio is more than 1, so let's say it's 2, that means you have 2 times the cash you need to cover your debt that you need to pay within 1 year. If it's 0.5, it means you have 50% of the cash that you need to pay your debt within 1 year. So when we're thinking, so at the top of this we said, if you're looking at individual companies, you want to pick companies that will survive in the short term and thrive in the long term. The biggest thing to find companies that will survive in the short term are ones that have a current ratio. That means if cash goes to zero, if revenue goes to zero, if they're not making any money, they have the cash already on their balance sheet to survive.
So we want a high current ratio.
Yes.
As high as possible.
Yes, but not stupidly high, because that could be a red flag.
So before we look at some examples of current ratio and debt to equity and the like, do we want to just quickly address the second element of a good balance sheet? The second element that we look for in companies that are going to survive and thrive, and that is stable earnings.
Yes.
Which in an environment like this is tough.
Yeah. I think, look, we've sort of banged on about earnings and, moats and stuff like that a lot on this show. So I don't think we need to go too into this. But there just needs to be a thought to companies that can keep ticking over in this time period, so they're not going to go out of business in the short term, and then have the ability to, either keep customers through this period or, draw customers back in really quickly afterwards. What you don't want businesses that basically have to start from scratch again. And, companies that have strong brand loyalty or strong network effects or, other types of moats are businesses that are going to be really good businesses to own through this period and out the other side, because they'll emerge stronger and they'll be able to regain their footing quicker. If a business had really volatile sales numbers, if they had a really high customer churn rate, if they didn't seem to have a lot of brand loyalty or anything like that, potentially those businesses are going to take a little bit longer to find their footing out the other side. And potentially the businesses that have strong balance sheets and then can get their earnings on track really quickly after this shock, they're going to be the ones that will be able to take advantage of whatever opportunities come out of the other side. And we know that there will be bankruptcies in this period. We know that the economy is going to change massively. And there will be companies that win massively out of this year, that come out the other side, can acquire businesses for pennies on the dollar, can capture customers that their competitors previously had. And they're the businesses that you want to own. The businesses that can really hit the ground running and do well as a business and do well for you as a shareholder.
So without further ado, we should have a look at what is on the watch list to give some examples of what we have been talking about, Ren. So we've obviously got a lot of opportunity in the tech space. It'll be interesting to touch on some online retail and then, more broadly have a look at what's available. So what are you looking at?
So to kick this off, we're going to reiterate that nothing is advice. These are just companies that we're looking at, and you need to do your own work, essentially. And as part of that, I think we're going to err on the side of throwing more names out there than less, so no one can accuse us of just putting one or two names out there and then people actioning that. Yeah?
Yeah.
So you mentioned the tech giants. Let's start there, because we said cash is king, and no one has more cash than these big tech companies at the moment. Microsoft, Alphabet, which is Google, and Apple all have over $100 billion on their balance sheets. They have $100 billion in cash or cash equivalents that they can use to pay their workers, pay their rent, keep the lights on, and maybe potentially make some big acquisitions out of the other side. So to give you an idea of some of these big tech companies and their current ratios, Facebook is 4.4. So it's got about 4.5 times the cash on its balance sheet compared to the short-term debt obligations it has to pay within the year. Alphabet, 3.3. Microsoft, 2.8. Apple, 1.6. So they're all very cash rich. They have the cash to pay whatever debt obligations come due within the next year and then some. So that's a few companies. Do you want to throw some in there?
No, Ren, continue. I've got one to throw in a little later.
One other tech company that is interesting is Oracle, which just is a free cash flow producing machine. So that's another one that people might want to do some research on. If we move away from tech, obviously a big winner in this time is going to be online retail. My attitude, I don't know what your attitude is, I'm not trying to buy companies that are just going to do well in the next 6 months. I'm not trying to get into, Zoom video communications, which a lot of people are getting excited about, or some of these online gaming stocks and stuff like that people think will do well because everyone's locked in their homes. I completely understand why you would do that, but I just want to invest for a longer period of time. But I think there are a few online retailers or people connected to that online retail space that will do well, not just in the next 6 months, but in the longer term. So Amazon's obviously a massive one. Amazon's a big one, both for its online retailing business and then Amazon Web Services. As the economy changes in the next 6 months and people do more stuff online, Amazon Web Services will likely get more business as people spin up stuff really quickly and don't want to build servers themselves. Uber is an interesting one, which has kind of been punished before coronavirus and in the early stages of coronavirus, but their stock has gone up big time since their CEO came out and reminded the market that they have $10 billion of cash on their balance sheet and another $2 billion credit line that they can draw on. And I would hazard a guess that the Uber Eats orders are going through the roof.
Yeah.
Speaking from my personal experience, I can I probably have contributed to that stock price uptick just in my increase in orders. So I think Uber's an interesting one. Shopify, which do a lot of the back-end payments infrastructure for small online retailers, I think is an interesting one. And then Walmart and Kroger in the US, Coles and Woolies in Australia. The UK and European retailers, supermarket retailers, don't excite me as much because it is just competition central in there. The German discounters have just slashed and burned their way across Europe. I think especially Walmart is a massive company that looks to benefit here. So the online retail and the supermarket retail space is interesting. You want to throw any in?
What about Marley Spoon, for example? I'm interested to see how they go.
They even publicly traded?
Yeah.
Jeez.
Yeah, publicly traded, and I'm not sure. I mean, they have a relationship with Woolworths. It'd be interesting to see.
Jeez, their share price was up 83% from Tuesday to Friday last week.
Well, there you go. So you can understand people are probably looking for alternative ways to get food to their front door.
Wow.
What about some of the other big hitters in Australia? I mean, for me, top of mind, you've got Treasury Wines.
Yeah, Treasury Wine is trading at a price to earnings of like 9 at the moment.
So that's a big one. They have the Penfolds brand within their stable of wine. They have been sort of hit because of the impact of China, or China was one of their big markets, but good opportunity there.
They've got a current ratio of 2.25. It's 2.25.
That's good.
So it means that they've got cash. I think they've also got heaps of inventory that they're trying to shift, which it makes sense because, everyone's making it tough to export at the moment. But yeah, I think Treasury Wine is a very interesting one, and it's probably at a price that you haven't been able to get it for
a long time.
More than 5 years, I would guess.
My stock pick to beat CBA in terms of its market cap was CSL.
Yeah.
It's another one that is probably providing some good opportunity.
The crazy thing is, though, so just on the metrics that we're talking about, their current ratio is 2.2, so similar. The crazy thing about CSL is have a guess where its current share price is, like when it hit that before.
What?
So you know how with Treasury Wine Estates I said, it's probably at a price you haven't been able to get it for 5 years.
Mm-hmm.
Where do you think CSL, which is now in like the 270s, where do you think it last hit that?
Hit 270?
Yeah.
Quite recently.
Yeah.
Yeah. I'm going to say within the last 3 months.
Yeah, like the start of the year.
Yeah.
So even though it's fallen from, it's fallen $60, that's how much it ran from.
It went nuts.
Yeah. It's crazy.
What else?
Brambles, I think, is an interesting one just because it's trading at a PE of like 8 and it's got some cash on its balance sheet and stuff like that. ASX is potentially an interesting one in Australia. Just the volatility's back, which is, good for its derivatives and futures and all of that. But I just think ASX gets paid on activity, and so I think they'll do quite well. CME Group, which owns the Chicago Exchange in America, will do very well out of this volatility as well. And then there's probably a number of exchanges around the world that will also do quite well just out of this increase in activity. When we interviewed Elon last, he was talking about making an ETF, BetaShares making an ETF of exchanges.
No, that was a competition.
Yeah, but I thought they were going to do it.
No, I don't think so.
Oh,
I
really?
think it was it's just a competition.
I would have probably bought that. Anyway, Elon, if you're listening, make it. I obviously have a bias for overseas, so a lot of the other companies that I am looking at are overseas. So do you want me to just punch out some names really quickly?
Smash through it.
Caterpillar, the big heavy equipment manufacturer, trading at a PE of 9, a current ratio of 1.5, and you just see Caterpillar everywhere. Similarly, John Deere, which has been smashed recently, but they're doing a lot in precision agriculture, which I think is really interesting. Trading at a PE of 10 and has a current ratio of 2. Just going to throw out some names that I think are interesting at the moment with their discounts. Disney, D.R. Horton, a big home builder in the US. Spotify, I think, is interesting.
Yes.
Tesla, potentially controversial because as oil prices fall, that makes internal combustion engines more attractive. But potentially Tesla is going up against a bunch of automakers with really shocking balance sheets.
Yeah.
And so who knows? Like the US government bailed them all out in 2008, 2009. Will the US government need to bail some of them out again if no one's buying cars for the foreseeable future? McDonald's, I think, is interesting. It's just a giant business that will keep going. Home Depot is it's like the Bunnings of America, for those not familiar with the company, and it is just a free cash flow generating machine. Mondelez, the big FMCG company, people are going to be stocking up on Oreos and other snack foods. So in the short term, they'll do quite well, but they're just a great business with some strong brands and strong moats. Similarly, PepsiCo, I think, a similar argument. Bayer, I think, is interesting. Activision Blizzard, I think, is interesting. One gaming stock that has a really strong balance sheet and potentially is interesting, Las Vegas Sands, strong exposure to Macau and Singapore, which are big gambling hubs. Yeah, there's a bunch of others, but...
Nice, Ren.
Yeah. No, there's a big name that we haven't mentioned, but...
And what's that?
Thought I'd leave it for you.
What's the big name?
The biggest of names.
Yeah,
the
come
biggest
on, bro.
of cash
I'm
piles.
so surprised that you haven't put Berkshire Hathaway
Yeah,
in
there we go. Well, you know.
One of the big heavy hitters and in a time like this, you would expect with so much cash on their balance sheet, what were you saying, 120 billion?
120 billion, yeah.
Thereabouts, that you'd be expecting Buffett and Munger to be making some purchases in this time. This is the event that he has been waiting for, and I'm very excited to see what he decides to do with such a large sum of money. You as a shareholder, assuming, would equally be as excited, but I guess watch this space. There's going to be a lot of opportunity for him out there, and they've also taken a bit of a beating. So if you are looking to get into Berkshire, now might be an opportunity to do so.
Yeah, nice. I also think, sorry, just cut me off when you've heard enough companies. I also think Visa and
That'll be very soon.
I also think Visa and MasterCard could, they're very interesting long-term plays, I think. And, you're probably not going to get a chance to get them cheap. I think just companies with moats, companies like Nike and stuff, they're going to get smashed in the short term as people stop going to stores and buying. But I think over the long term, they'll do quite well. Nike has a current ratio of about 2, so they'll be fine. There's just so many companies out there, like Adobe, stuff like that, like PayPal, potentially they're good buys if they're cheap. There's just so much.
I think the message is that plenty of opportunity to find these good, strong brand, big moat sort of companies. Ren, to your point, there are a lot of out there. And this is where the ETF game comes into play.
Yes, yeah.
You can get access to a lot of these companies through ETFs, listed investment companies as well. So don't feel like, you need to go out and buy every single one of them, because you can do so in some very effective trades as well. So think about your ETF composition as well as LIC composition, and can probably benefit reasonably well. But
like Procter & Gamble, Unilever, strong brands, all the American banks, Wells Fargo, JP Morgan,
yes.
Goldman, Bank of America.
I'm going to cut Ren off there. There's plenty of opportunity.
Do you want me to just read the list of the S&P 500?
No, that's the point. The S&P 500.
But not
They're
even,
there for a
also,
reason.
look at Europe. Europe's been smashed at the moment, but there's interesting companies there. Australia has interesting companies.
Long story short, plenty of opportunity.
Should we do an episode where I just read company names?
No. So there's not much to really summarise there, and I guess the key message is strong balance sheet, plenty of cash to be able to cover what is going to be a pretty tough time over the next 12 months or so. Make sure they have the ability to service their debts and come out stronger on the other side, especially relative to their competition. And also look for these opportunities where companies have absolutely been smashed, but to Ren's point, strong brands that have good moat, competitive advantage, and without doubt should come out stronger on the other side.
One thing that I forgot to say, sorry, a lot of the metrics that you're going to see are going to start looking very attractive. Your price to earnings, your price to sales, stuff like that will start to look very good. You have to remember that a lot of those metrics are trailing 12 months.
Yeah.
So they take the last 12 months of earnings and then they apply the current price. Earnings will be downgraded. Sales will be downgraded. Even for companies that are largely shielded, if 20% of a country's workforce loses their jobs and loses their income, that will affect companies that are even just sell online. So when you're looking at some of these metrics and doing your analysis, unless you're doing the work to project down what the earnings are going to be, And that might just be as simple as looking at the company's earnings updates, because they'll probably have to update the market on what their earnings are going to look like. Just take those ratios with a grain of salt.
Yeah, nice. Well, Ren, we'll leave it there. Plenty to talk about. If you haven't listened to our bonus episodes been releasing over the last couple of weeks, definitely do so as we check in with some experts to get their thoughts on what's going on. Join us on our Facebook group and also hit us up on Instagram. Follow us there if you don't, because we're keeping tabs on what's going on there as well. So always good to chat, Ren. We'll leave it there.
Love it.
Talk next week.
Everyone stay safe out there.
Yes.
Thanks for listening to Equity Mates Investing Podcast, a production of Equity Mates Media. Please remember that everything you hear in Equity Mates Investing Podcast is general advice only. The content has been prepared without knowing your personal objectives, specific financial circumstances, or goals. The host of Equity Mates Investing Podcast may maintain positions in the companies discussed. Before considering any investment, please read the product disclosure statement and consider speaking to a licensed financial professional.